Hello, welcome back, founders. Live Founderama. I think it's episode 6. So we had 4 episodes or 5 episodes last week, and then trying to continue. Welcome back. Just a few seconds early. All right, so this week is going to be interesting because I'm trying to bring on guests, right? So tomorrow I have someone special, Tony, my friend. We're going to be doing Web3 startups within the Web3 sector, and very, very interesting. And then on Wednesday, I may have another interesting episode with another friend, Simon, and another friend of a friend, Javier, and that's going to be AI, and then human speech, not human speech, all that. So I have some exciting kind of episodes lined up for this week. Okay, so today, quickly, let's get into the topic. I don't know. I felt that doing funding related topics might, just if it's just funding, you might find it a little boring. But I thought that I needed to do these on a regular basis because, yes, the things that I'm going to talk about, they're all, things that you already know. If you guys are you're looking for seed funding, you probably know a lot of the things that I'm talking about. But I'm trying to come from an investor perspective. So even though I am a startup funding advisor, I'm also an angel investor, and I'm a part of a syndicate of family offices and angel investors. So I bring that to the table. Okay, so today we're looking at the key metrics investors look at when evaluating startups. So let me share my screen, and as always, let me share my screen if I can. There it is. Okay. Key metrics investors look at when evaluating startups. The first one, like I said, most of these things everybody knows, right? So you guys know these things, but I want to really go through them from an investor perspective, right? So first one, important one, is customer acquisition cost. Investors want to see that your startup is able to acquire customers efficiently and cost effectively. That is the key word. Tracking your CAC can help you optimize your marketing and sales strategies and demonstrate your ability to scale. Okay, now, so a lot of the pitch decks that I see and pitches that I participate in or advise in, they talk about customers, they talk about projections. So they say, by 2025, we hope to get 5,000 paid customers, 10,000 total users on the system, something like that, right? Which is good, fantastic. This is what you're forecasting. This is the projections that you hope you will have. But what's missing most of the time, 99% of the time, is cost effectively, right? So they don't really do customer acquisition costs. They don't break it down and say, right now, it costs us $3 to acquire a customer. But if we do this, this, and this, it's going to go down to $1.50, or it might go down to 80 cents. And to do that, part of the funds we're seeking is going to be allocated for that. You see where I'm going with this, right? So it really creates a very powerful kind of incentive for the investor when they see this, and it also tells them that you understand what is important in scaling. Customer acquisition is important. It's not even product development, right? I'm not talking about SaaS. But this is applicable to any other sector, even if it's a product-based, a widget, a gadget, whatever it is, right? Customer acquisition determines your scaling, the growth, and your ultimate kind of valuation, the reality of the valuation. Because if it's going to cost you $50 to secure or to acquire a customer, then it's going to be slow because you're going to be burning through a lot of your capital or your marketing costs. And I'm going to get to that in one of the slides. But so this is very important. Pay attention to this, understand what it really means and what it really communicates to the investors. All right, next one, lifetime value. Another obvious one, but something that none of the pitch decks that I've seen in the recent past talks about. They don't talk about this. LTV, lifetime value, measures the total value of a customer to your business over the course of their relationship. Investors want to see that your LTV is higher than your CAC, which is customer acquisition cost, demonstrating a strong return on investment for customer acquisition. Now, the way to sort of talk about your lifetime value of a customer LTV is to have a slide, have some information in your pitch that lays down some basics of what this relationship is, right? So maybe your SaaS product, typically on an average, people might use it for 4, 5, 6 years. I mean, it could be more, right? I mean, I've been using Basecamp. In our agency, we've been using Basecamp for forever, for, I don't know, 15 years, probably more, since its inception. The lifetime value of a customer on Basecamp, that's tremendous. But there are some products like Superhuman, right? So Superhuman is an email client that I was in love with at one point in time, but we moved to Hey.com, right? We moved to Hey in favor because not just the cost, but several other factors. So lifetime value is very important. If the lifetime value of a customer, and not just assumption based, right? So I might think, oh yeah, my customers are going to hang around for 15 years. So therefore, yearly value is $1,000. So it's $15,000 lifetime value. If it's just your assumption, it's not backed by any kind of facts or logic, it makes no sense, right? So you need to be able to demonstrate at least a reasonable scenario of the lifetime value of your customers, right? So that's lifetime value. Next, monthly recurring revenue. Very simple concept. Everybody knows this. MRR. MRR measures the amount of revenue your startup generates each month from recurring subscriptions or services. Or it could be sales. I know. Most of these are targeted to SaaS kind of startups because that's what I specialize in. So investors want to see that your MRR is growing steadily over time, demonstrating strong traction and revenue potential. Okay, if you're at a stage where you're not generating any revenue, this does not really apply to you. But I say that if you're seeking funding, even at the seed stage, it's good to have a little bit of traction in terms of revenue, even if it's just 5 users, 5 paid users, right? Get those. Figure out, try and find out what it takes to get those 5 users at least. If you get a 500 users, fantastic. 5,000 blows the lid off. In fact, one of the biggest exercises that I do, workshops that I do when I'm advising a startup when they're seeking seed funding is this. If they don't have a revenue, then we pay a lot of attention to try and come up with strategies on what can we do? What can we do? Because look, you got to demonstrate that people are willing to pay for it, right? And would 5 paying customers really demonstrate it? Yeah, it can, if it's done legitimately, authentically. It's not just 5 of your friends or family members who are paying, So anyway, so monthly recurring revenue, very important metric. You need to be able to demonstrate that, not just assumptions, but demonstrate. 4, gross margin. Gross margin, measures the profitability of your product or service before overhead expenses are factored in. Investors want to see that your gross margin is high enough to support long-term profitability and growth. A lot of the time, I don't see this either in the financial statements. Some people might say, isn't that a bit too deep to include gross margins? I say no, it's not. Because this is about long-term profitability and growth. This is what investors are really looking at. It's not even your idea. Your idea doesn't have to be groundbreaking. It doesn't have to be unique. It doesn't have to be, spectacular. It could be a normal kind of idea solving a simple problem. But if you can demonstrate that, these things like MRR, your gross margins and profitability and growth and scalability and customer acquisition costs and lifetime values and things like that, it then puts that into context because the investor is thinking, okay, they are seeking, I don't know, $1 million. And this idea may not sound spectacular, but it's going to be a healthy, profitable business. It's going to scale. So, it makes sense. Okay. Number 5, churn rate. Very important. Churn rate. So, churn rate measures the rate at which customers cancel or stop using your product or service. Investors want to see that your churn rate is low, indicating strong customer retention and loyalty. And so, this is a tricky one because a lot of founders, when they send in their pitch decks, and they already have a user base, they try to show some figures, which the authenticity of how you acquired those users is comes into question. And like I always say, investors are not fools, right? So if you say you got a 5,000 user base or 500 user base, the first question that comes into an investor's mind is, how did you acquire these and who are these, right? So what is the churn rate? Like you could, I don't know, ask, let's say you have 5,000, connections or followers or whatever it is on LinkedIn or social media. And you could send out repeated requests begging people to, guys, please just sign up. So we're testing our system and you may have a few hundred signups. Then you go into the dashboard, you take a screenshot and you're saying, okay, this is the user base. But look, the churn rate will drop off because these guys, because of the relationship they have with you on LinkedIn, maybe they like the content you're putting out there. They love your personality or authenticity, whatever it is. And then they say, you know what, let's help this guy out. But in a couple of months' time, in a month's time, they may actually, first of all, they may not engage on the system at all. They don't log in. So there's lots going on there. So churn rate is very important for people who are at the beginning. But if you already have real users, then churn rate is even more important. If you have a bad churn rate, then spend your time and resources figuring out why, instead of trying to hope that investors won't notice it, right? Or they won't care about it. All right. 6, runway. Oh my God. I would say one of the most important concepts and terms, runway. Runway measures the length of time that your startup can operate without additional funding. Investors want to see that your runway is long enough to allow your startup to achieve key milestones and attract additional funding if necessary. So usually I see this runway being mentioned in a pitch deck on the what are we seeking slide, right? So seeking $500,000, $1 million at equity, pre-value, blah, blah, blah. And then allocation of funds, a bullet item says 12-month runway. Okay, it's better than nothing. But this runway thing is very important. You gotta let investors understand what it really means. What does it mean? What is your runway? Look, even if you're making revenue, right? If you're making money on the initial kind of whatever platform or whatever product or service you're out there, it doesn't necessarily mean that you have good runway, right? So runway can mean, and it's related to the next point coming up, runway can really determine the health and what you think, your confidence levels, right? And the reality of your project. If you say that if as a founder, if we say the lower number for the runway, it indicates confidence, not really. If you say 6 months runway, right? which means you're trying to think that the investors would be worried if you said, oh, we need a 12-month or an 18-month runway. That's the wrong way of thinking. Look, investors are not fools, right? So they're not going to, in fact, I need to tattoo that, investors are not fools on myself. Look, they are going to think about it from a sector perspective, from a reality perspective. If customer acquisition is difficult for that particular idea, for that venture, or rather the initial customer, so you might have a snowball effect later on, you need a decent runway for product development, to pay team members, to pay yourself, all that. All right. So that's runway. Let's look at the next one. Number 7, which is related to runway, burn rate, because burn rate determines runway. Burn rate measures the rate at which a startup is spending cash. Investors look for startups with a sustainable burn rate, as this indicates that the startup can manage costs effectively and maximize the chances of success. Okay, the days of spending money, because there was cheap money in the market and everybody and their uncle got funded. And therefore, as soon as they got funded, they were hiring people left and right. They were getting fancy offices and this and that, and they were burning through. That's stopped. That's going to stop. That stopped 2023 going forward. So burn rate is very important, and you need to have a real understanding of what your burn rate is. You need to factor in things that you may not have thought about. That then indicates to investors that you're very thorough, you're detailed, you are real, and you understand the stakes, right? Because ignoring burn rate, trying to minimize it, maybe you have attorney fees, which you feel like it's not important enough to mention on I'm sorry. I hope I haven't coughed into this live. And I hope you can hear me, just to make sure. Yeah, you can hear me. Okay. Forgive me for that. I don't know. I was hiking this weekend, and I and my wife, we did a 10-mile hike. It was a bit cold, and I think I picked up a little bit of a sore throat. But anyway, let's get back to the business at hand. I hope the mic is on. Yeah, it is. Okay, so burn rate, don't think that, in fact, by mentioning the things that would contribute to your burn rate, you're being transparent, you're being authentic. So don't be afraid of burn rate. Burn rate is not going to look bad if it's reasonable expenses, right? If you're going to be spending on some nonsense, then yes, but just make sure that you factor into your burn rate a lot of things. Okay, this may not be something that this is not a common one, but I wanted to include it because it is important to me, at least, and to the investors that I know. NPS, Net Promoter Score, measures the likelihood that a customer will recommend a startup's product or service to others. This goes back to both the CAC and the LTV. Investors look for startups with high NPS, as this indicates that the startup has a strong reputation and is able to generate positive word of mouth and customer referrals. Okay, if you're brand new, you just have a small user base, then yeah, you may not have much NPS, a big NPS score. But even if you're new, it serves to figure out what you can do to try and capture this NPS. What can you do to generate NPS? What can you do to show NPS, right? So this means, maybe running a campaign, a loyalty campaign, or something of that sort. But it's something that is very important, and it's a secret that no one talks about, but investors, they look at this. They look at this. They want to find, and they'll think through, and they will say, okay, based on the sector, based on the service or product or venture. They say, is there an opportunity for creating word of mouth in this? Is it that kind of a product? Because sometimes, no. And I was actually on a call just before this, and I was, it's a strategy call, brand strategy call for one of our clients, and we were discussing this. And one of the biggest problems they have is their product is so good that their customers are not willing to talk about the product in public or to give testimonials because they don't want their competitors to know that they're using this. So it's their edge, right? It's a secret edge. And that is a tricky. It's good to have that. A product or service to have that is great. That means your product or service is so good. But it also lowers your NPS. And it's a tricky one. And yeah, you can come up with strategies to mitigate that. And in fact, that's what we were working on in the live call that I had just before, about an hour back. So think about this, figure out your NPS. Number 9, time to market, very important. And yes, it is. Most pitch decks mention this. They do have some kind of a milestones kind of timeline thing. Time to market measures the amount of time it takes for a startup to develop and launch a new product or service. Investors look for startups with a short time to market, as this indicates that the startup is able to move quickly and respond to market opportunities and customer needs. Okay, now this is a bit it's got contradicting attributes to it, because yes, investors are looking for startups that have a short time to market, but it depends. It depends on the idea. It depends on the sector. It depends on a lot of things. So be realistic again, because investors are not fools. If your time to market, if you feel that to have the right kind of soft launch, to have the right kind of traction, once you launch the MVP, you need to take a little longer, it's okay. Okay? But try and be efficient about it. See where you can speed it up, where you need to slow it down. And time to market is something to think about. It's a metric you need to think about. This is what investors also think about. All right, the last one, number 10, intellectual property. Again, something not a lot of founders talk about in their pitch decks, in their slide decks, right? IP measures the legal protections that a startup has for its proprietary technology, products, or services. Investors look for startups with strong IP protections, as this indicates that the startup has a defensible competitive advantage and is able to protect its market position. So this one, a lot of, if it is indeed patentable or it's some kind of a new proprietary algorithm, some founders do protect it before seeking funding. Some say that part of the funding will be used for getting that patent or that copyright or the trademark or whatever it is. But it is something to think about. It makes you look like a sophisticated founder if you include some information about your IP, or at least at the very basic, who owns the IP. I look at pitch deck after pitch deck where they have an algorithm or some kind of an idea, some kind of a process, which they say it's proprietary, but they don't mention who owns it. If you own it, that's fine. Can you prove it? Have you applied for at least a copyright, right? At least the idea, at least some kind of have you searched for it? Have you got an attorney to do a basic search? So yeah, an IP information. It doesn't need to be a slide. Some information somewhere is important, right? Okay, so those are the 10 key metrics, at least for this this live episode, that I feel are pretty important for founders. Let's go ahead and see, first of all, if this is live and if there's any questions. Oh, fantastic. Simon has a question here. You mentioned on slide 8 a product where everyone wants to keep it secret. What was the product? Okay, I can't really mention it, right? So, but it is to do with the care sector, health, care. Not even health, it's care. Okay. That's all I can say, not more. But okay, so let's see. Let me go and check on Twitter to see if there is if there are any questions from anyone. Twitter. Okay. Let me go to YouTube and okay. Right. Yeah. Okay. Nothing. But that's okay. That is for today. And hope you guys had a great weekend. And I posted something on the weekend when I just got back from my hike. And I told you the 10-mile hike with my wife. And I posted saying, founders, if you want to reduce your fears, hike every day. And I truly mean it. Okay, maybe not every day, but at least on the weekend. Now look, founders, we have fears, right? We have fears every single day. And by the way, I don't know if you're connected to me on LinkedIn, or if you're on LinkedIn, go check out my profile. And I added a new kind of position. It's a stealth startup. So onto my new journey. And so I'm a founder all over again, right? With all this knowledge. Yes, sorry, just to Simon is commenting on LinkedIn saying A16Z was talking recently about the lack of new tech in the care industry. Oh yeah, and yeah, I'm working with someone who it's a startup that's probably gonna make a huge difference. Okay, so as I was saying, so I'm a founder all over again. With all this experience, having invested in dozens of startups, my own money, having worked with syndicates and matchmaking investments to dozens and dozens of startups, founders, my own kind of exits. With all this, right now, a new startup is stealth mode, and I feel like a founder, and I've got all the fears coming back. So it's good to face your fears, and it's okay to have fears. But to help you with that, I found hiking to be highly, highly effective. Hiking gives me creativity, and it, when you're in nature and it's challenging, so it's, you're going through a terrain, it does sometimes help you access the recesses of your mind, and sometimes you come up with epiphanies, and sometimes you come up with ideas and all that. So let's all hike, all right? And share with me, if you're hiking already, hit me up on Twitter or LinkedIn and let me know what your your experience is of hiking and all that. All right, guys. So, guys and girls, that's all for today, and hope you enjoyed this episode. Yes, there are many other metrics that you can track. I just wanted to take 10 of them and just talk about them. Tomorrow, it's going to be a very, very exciting episode. I'm going to bring on Tony, my friend. We're going to be talking about Web3 startups and what to do, what not to do. Yeah, it's going to be fun. So don't miss that. Tomorrow's episode, 10:30 Eastern Standard Time, live on LinkedIn, live on Twitter, and live on YouTube. All right, till tomorrow, go forth and prosper. Take care, guys and girls.